Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com, and you're tuned in to On Trend with Arthur Hill, of course. So what are we going to talk about today? Well, today our show is entitled Divide and Conquer. And I'm going to dive into SPY and the sector weights. I'm going to dive into QQQ, look at the key drivers, and then show you how to break down the sector SPDRs. But before we do that, we're going to show you some sources for ETF components, because I think it's very important to know the ETF components and the weightings, especially in these large cap driven ETFs. Very easy to find. So I'm just going to show you our poll and remind you that we do have a question box there. The poll today is, what is the combined weighting of the materials, real estate, and utilities SPDRs within the S&P 500? And here, of course, is the question box. And there you can see I haven't asked a question, but I put in a little comment there. So onward to our presentation. Now, the first thing I'm going to talk about is going to be a follow-up. Last week, I talked about breadth indicators, and I was talking about how they did not look that inspiring. In particular, we hadn't had a bullish breadth thrust. And that changed on Friday when we got a bullish breadth thrust. So here are the advanced decline percent indicators. Advanced decline percent is the number of advances less the number of declines divided by the total number of issues. So using the NASDAQ 100 as an example, if you had 80 advancers and 20 decliners, that would be 60 net advancers, which would be 60%. So by taking 80%, you can compare the S&P 500 with the S&P Mid Cap 400 with the S&P Small Cap 600, and that's what I've done here. So we had some good positive breadth, coming in early April. And then in this little stretch here in the second half of April, the breadth wasn't that impressive. You can see we got a nice up day in late April there, that red arrow, but breadth didn't get above 50% for the S&P 500, above 25% for mid caps, and didn't get above 25% for small caps. So that didn't show enough enthusiasm, or the participation was not broad enough during that surge that we had. But if you look at the surge that we had on Friday, 3 days ago, you can see that 80% moved above 7 cap 400. In fact, it moved above 75%. So that basically means for the S&P 500, you had more than 425 advancers on that day. And that shows that participation was broadening, and that is a one-day breadth thrust. Now, one day does not a trend make, but I still think we are in a bull market environment. So that breadth thrust definitely suggests that we are turning for the short term and could be poised to challenge that April high that you see up there. The only thing, of course, that would negate it would be a bearish breadth thrust below minus 75%. Now, there's always stages to a reversal. You've got the bottom picker stage when you become oversold. You've got that first initial impulse, might be a hammer gap, might be a bullish engulfing, might be this breadth thrust that I just showed you. And then the next stage would be what they would call maybe a follow-through day. You get that initial reversal, and then you get further gains that give you this follow-through. And the second breadth indicator that I talked about last week, the 10-day EMA of advanced decline percent. And we had the two bearish breadth thrusts in February there, you see with the red ovals when they moved below minus 30% for the S&P 500 there twice, and also for mid caps. And you can see that, we got up to the 20+% area twice, but couldn't punch above plus 30% to get that bullish breadth thrust to negate these signals we got in February, March. And that's what I'm looking for to suggest that we've ended the correction in the S&P 500, because basically we've been moving sideways in 2018. So that's basically a rest within a bigger uptrend. as I showed in Chart Watchers over the weekend. So we need to get a couple more big days to get above plus 30% there. Now, one other item, you can see that the actual value is there on the right because I'm displaying the value of the 10-day EMA with the y-axis there. So we got 7%, mid caps 15.83, small caps 10.81, and the NASDAQ 100 15.57. So the leaders over the last 2 days would be mid caps and large cap technology. All right, now before we go to divide and conquer and look at some of these individual ones, I want to show you where you can get the holdings for your key ETFs like SPY and QQQ. And the ones I'm showing are all driven by large caps. And that's why it's important you understand the main drivers because they are seriously heavily weighted towards the large caps. And so all I did was I went into Google and I searched for XLF SPDR holdings. And there at the top, you can see the sector's SPDR website. Go directly to the source. All right, don't go to ETF.com, Morningstar, Yahoo. Go to the source to find the actual holdings. And so you can see here, I'm on that source for financials, and it gives me the holdings. I can download them as a CSV file or an XLS file. But right there, you can see the top 3 holdings account for over 30% of the ETF. So if you're interested in XLF, you better be watching these 3 charts: Berkshire, JP Morgan, and Bank of America. Now, the other one that I'm looking at would be SPY. And I always keep an eye on the sector weightings. The individual stock weightings, sure, they're important, a little bit less so because they're more spread out because you have 500 stocks. But if you look at the sector weightings, it's quite amazing. Technology, 25.67% of the ETF. The next biggest sector is finance at 14.5%. So, and with technology, you have to actually add in telecommunications services because telephone and Verizon and CenturyLink, I believe, are part of the technology sector. So that sector only has 3 stocks in it. And as far as XLK is concerned, they're part of it. So that makes technology in real life even bigger. And then we can see healthcare, consumer discretionary coming in at 13%, industrials at around 10%. And these 5 sectors account for over 75% of the S&P 500. So if you want to know the direction of the S&P 500, you pretty much just need to watch these 5. You can ignore the other ones. These last 3, materials, utilities, and real estate, count for less than 9%. All right, they're not going to have a big influence on the broader market. All right, now let's look at some charts related to this. I'm going to we're going to skip Zillow for now. So I have to scroll down a little bit. So first we've got QQQ. And I've got the top holdings there for reference on the left. Apple, 12%, Amazon, 10%, Microsoft, 10%, Google, 9%, and Facebook coming in at 5.5%. So right there, you can see something like 45% of the ETF is concentrated in 5 stocks. And so when I look at QQQ, I'm also looking at these stocks. All right, what are they doing and how are they driving the market? Well, look at the number 1 stock in QQQ. It's Apple. It's at a 52-week high. All right. It had this gap down on some earnings fears or iPhone 10 fears. And, this brings up this narrative stuff. Forget the narrative. All right. Forget the narrative of Iran. Forget the narrative of North Korea. Forget the narrative of the employment report. Once you attach a narrative as a reason for a stock moving or the stock market moving, you've got to follow that narrative. And narratives come and go. And so if you're basing your movement on that narrative, you have to follow that narrative to see if it changes, to change your reason for the movement. Now, frankly, I think the narrative comes after the price movement. So what happens is the price makes a move And then everybody scrambles to find a narrative that fits the price move. So that's why, you're never going to see me mentioning employment reports, Iran, North Korea, whatever. The narrative just doesn't matter. Pay attention to the trend and the price action. So if we look at the trend for QQQ, it's clearly up. All right, that's a 52-week high. This is a higher low from February to March, and we're turning up again. You can see Apple's at a 52-week high. That is bullish for QQQ. I mean, yeah, maybe it's short-term overbought, but it's definitely not weak, and it's one of the strongest in the group. Google is one of the strugglers, okay? You can see that it's been declining. Well, it's at the bottom of its range for 2018 here. Maybe that's a descending triangle. I'm not sure. But I thought it's getting a bounce off support, but it's already fading. It can't take its 50-day. So if this is a descending triangle and you break support here, that's going to argue for a continuation lower. So Google's not one of the favorite ones here. Microsoft, on the other hand, has got a nice, steady, boring uptrend. Maybe it is the most boring of the big technology stocks. You think Windows, you think Office. Yeah, there I go with that narrative. Better stop. But, it's just a nice, steady uptrend with new highs. So this is a solid stock. Amazon, a solid uptrend as well. It hit a 52-week high there in late April. So that's doing just fine. So we can see that 3 of the top 5 are doing fine. Apple, Microsoft, and Amazon. So that bodes well for the long-term trend of QQQ. And then we can see Google is struggling. And Facebook, I'm not sure what to make of Facebook, because you can see here that, you had this pretty sharp decline with the gap down, and you've come back up and you've got a gap up. And one user wrote in and asked, is this an island reversal? Well, it's not an island reversal because this gap down here is not equal with this gap up here. To get an island reversal, you would needed a gap above 80 to create an island where bears would be trapped. So it's a gap down, gap up. The gap up is, technically bullish, but I think this is one that would not be on my preferred list. Apple, Amazon, and Microsoft look stronger. Then we get to the bottom 5. All right. Comcast, not looking very good at all. All right. Broke down below those November lows. Stay away. You see a chart like this, move on. No sense in messing with it. Intel, great looking chart. Kind of looks like Microsoft. All right. Nice, steady, choppy uptrend. Cisco hitting a new high, a nice uptrend. All right. So you can see the majority in QQQ of this top 10 are in nice uptrends. Now, then you can see Heliad, which is part of the biotech group. All right. It gapped down and broke support. So, it hit a higher high there and then just hit a lower low just now here in May. So it is not doing good. But if you kind of take a back of the envelope sum of this, you've got 1, 2, 3, 4 red arrows going down, and the other arrows are going up. There's only 9 on this chart. It didn't get Netflix, but it is in an uptrend. So that would make 6 of the top 10 in clear uptrends for QQQ. And that supports an uptrend for QQQ. So the next one we're going to look at would be the S&P 500 SPDR. And first I've gone and I've divided it into these sectors. All right. And I've got the top sector at the top, XLK, followed by the next sector, XLF. And we know XLK is in an uptrend already. 52-week high in March, higher low, and turning up here. So no worries there yet. XLF, a bit of a struggle because it has been falling. All right, this is a lower low, and this is a lower low. So we need to get above resistance here to get that red arrow out of XLF and get some sort of a breakout. All right, you may notice that I have a 50-day moving average on this chart. I'm using that not as a support or resistance level, but rather as a marker. So you can see that SPY is right at that 50-day. And then you can see that XLK is above it. So by definition, it's above and it is showing relative chart strength relative to SPY. XLF is below it, so it's one of the weaker ones. XLV is below it. XLV also had a lower low here, and it's looking weak. So XLF and XLV are not looking good. XLK is looking all right. Here is XLY, which is heavily weighted towards Amazon, as you will see. It's just been going nowhere because Amazon has been going up, and Amazon, as you'll see, is 20% of the ETF. But the rest of the stocks are either floundering or moving flat. So XLY is just unchanged. XLI is in a downtrend, lower low there. Maybe it's a big correction after a 44% advance, but we need some sort of a rally and breakout here to reverse this 2018 downtrend. So, you know, the SPY picture is looking a bit mixed, I have to say. You know, as you'll see, you got XLE in an uptrend, XLK in an uptrend, XLY flat, but we got healthcare and finance and industrials hurting. And that is keeping the market in check. And that's why SPY or the S&P 500 is trading flat. The weakest sector would be staples, 52-week low there. So a clear downtrend. Don't even look at that chart, or I'm not even looking at it. Energy, it's not above that high here, but it's up year to date and leading year to date. Utilities and REITs. Now, I really don't look at utilities and REITs. A friend of mine, a trader, said utilities are kind of like desserts at a Chinese buffet. You just don't do it. All right. You've eaten so much at the Chinese buffet that you don't even dare to take dessert. And utilities, he compares that to as far as stocks are concerned. They're kind of untouchables. But I think utilities are in a bear market. I think bonds are in a bear market. And I think those two are correlated. You can see the breakdown there. And I think this is a bear market rally. And now we got this sharp decline. So this is like a rising wedge. And I think we're going to eventually break down and move to new lows for utilities. And I think the same thing for REITs, because they're also tied to the treasury market, positively correlated to treasury bonds, negatively correlated to treasury yields. So a breakdown here in REITs is what I am expecting, because I think this is just a correction after this bigger breakdown here. All right, so let's move to within these individual sectors quickly. So if we look at XLK, it kind of resembles QQQ in that you can see Apple, a 52-week high, Microsoft, a steady uptrend. Google is struggling. Need to get a breakout at 1100, put that one back on. Facebook, again, I'm not sure. There's this 61.8% retracement coming in here. Is the gap resistance? I really don't know if a gap is marking resistance, but I see a sharp breakdown here, and this bounce looks like a counter trend move to me. So I'd watch out. It moved below 170. That could signal a continuation of this prior decline for Facebook. Intel, steady uptrend. Now, here's the thing about these sectors. You get stocks that you wonder, what are they doing in this sector? And we've got Visa, all right, hitting a 52-week high. Visa and MasterCard are part of this sector, and both are hitting 52-week highs and in strong uptrends. So that supports XLK. There at the bottom, you see MasterCard. So you think of them as financial stocks, but they're really technology stocks as far as, you know, their credit card processing. And then we have Cisco, which is, of course, technology. But we also have Verizon, which is a telecom, and it doesn't look good. All right. I thought Verizon was turning up here, and I wrote about it here in late April. I wrote about several telecoms, and sure enough, they just turned around and turned right around on me. So telecom is in the doghouse. Same for telephone, AT&T. So I'd stay away from them. Looking at consumer discretionary, look at the holdings. Amazon, 22% of the ETF, Home Depot, 7%. And then you get down to the rest, Disney, Comcast. But the total is 60% of the top 10 stocks account for 60% of the ETF. And that's why it's important that you understand these components and what's driving it. If you're looking at XLY, you definitely need to watch Amazon and Home Depot. So Amazon's fine. Home Depot, not so sure about. And they're going to report earnings very soon. So that's why they're kind of off my watch list right now. You know, you have a little breakout here and a little pennant maybe. So watch for a pennant breakout to signal a continuation higher. Disney does not look good. You know, I use this February, April low sequence to compare other charts. If you held above the February low in April, you're doing good. If you broke below it, you're not. All right. XLK held above it. It's doing good. But you can see Disney did not. Comcast did not. Netflix did from February to April, held above the low. It still looks like it's in a nice uptrend. McDonald's did not. Now, McDonald's is a bit questionable because you can see a clear resistance at 165 and it's trying to break out with this gap here. So maybe it's ready to turn up. Booking.com looks like a bullish triangle within an uptrend and trying to break out here. Nike, I lost my lower trend line, but that's an ascending triangle. All right, a nice uptrend to 52-week highs, a consolidation, and a breakout would be bullish. That's a bullish continuation. Starbucks, so I see a chart like this and I just say pass, move on. There's better, clear charts out there. It's been going nowhere for a long time. I'll still drink the coffee, but I won't look at the chart. So here's finance. You look at the top 10 holdings, account for 55%. All right. And at the top, as you saw before, Berkshire, JP Morgan, and Bank of America. So first up is Berkshire. You know, it's kind of got that descending triangle and it's trading at support. And then we look at JP Morgan. Now it's one of the stronger ones because it held above its February low in April there. It's testing support here. So it might be the one to watch if we get a bounce in finance. Bank of America, well, it did break below these lows, so it needs to get back above 31 to get some sort of a breakout going. Wells Fargo, that's an ugly chart. I'm going to move on to the next one. Citigroup is getting a big move today. Now, this may be a correction, all right, after a big move up in 2017. But we need to get a breakout at 73 to reverse this correction. Maybe got a little mini double bottom there. Goldman Sachs not looking good, broke support here. USB in a downtrend. So basically we have these April highs to watch for a lot of them. If we can start clearing these April highs, then finance will turn around. And Morgan Stanley might be one to watch because it's holding support here maybe. And a breakout at 55 would be bullish. And American Express is one of the stronger ones because it hit a 52-week high in April, a little falling flag and trying to turn up here. So a lot going on there. And I can see I'm running out of time here. But next up, we have the industrial sector. Top 10 account for 46%. All right. The only one holding up, well, one of the only ones is Boeing. All right, it's at support right now, but just moving flat. But if you look at some of these other ones, you can see that General Electric, okay, maybe it's turning up, and I'm not a bottom picker. All right, I'm not going to touch this, just like MC Hammer. 3M, yeah, it's oversold, but it's broke below this July low. It's one of the weaker charts. Honeywell looks a little bit better because this could be a correction, a corrective wedge. Need to get above that April high here. UNP, the railroad, looks better. It's one of the better looking charts because you got a higher low here and a triangle. So it looks like it's poised to break out. We've got United Technologies breaking down. So it needs to clear that April high. So a lot of weakness in the industrial sector. And Lockheed Martin, I think this is maybe an overshoot because now it's rebounding here because this is just a bit too much for a defense stock that has been leading. Looking at healthcare, top 10 stocks account for 50%, and I'm going to have to move on. But not a lot happening in healthcare except in medical devices and healthcare providers. XLP, not a lot happening here, but look at that. Top 10 stocks, 69%. All right, but a lot of downtrends there in consumer staples. Walmart looks like it's ready to break lower. The only one looking good is Costco here. So this is one sector you definitely want to avoid all the way. And then these other sectors, energy, okay, I do look at. We're seeing some pop and drop. ExxonMobil accounts for 22% there. And you can see the total, the top 10 stocks account for 73%. That is a heck of a lot. All right, so Chevron looks okay, but ExxonMobil looks quite shaky. Stay away from that one. I highlighted Schlumberger yesterday with what I think is a wedge breakout, but it's falling back. If it closed below that 50-day, that's going to negate the wedge breakout, definitely. And then you can see some other uptrends in ConocoPhillips, EOG, pulling back within an uptrend. Occidental, consolidating within an uptrend. Valero, very strong. Phillips, another refiner, very strong. And Halliburton kind of consolidating after that little breakout. So somebody's asking me about past episodes of On Trend are available for viewing. They are in the rotation, but we don't have a log yet of these past episodes, and we'll work on getting that out. For subscribers to Stock Charts, I do keep some of these videos on the Arch Charts website, on the Arch Charts section. It's not the website. Arch Charts is, of course, part of Stock Charts. So if you go to the all blogs here at the top and go to the bottom, see, I'm the last one. That's my pecking order on the totem pole there. So I talked about the breadth thrust, and last Thursday I put out a video, and that video kind of is what I talked about last week in On Trend. So you can find that video there on the breadth indicators and how they work and more details. And so we're ticking down. There aren't very many questions coming in, but feel free really next week, you can ask questions ahead of time once the question box is open, and that gives you time to think about. I'm always going to give you the opening on the title and what we're going to talk about, so you can ask questions based on that, what we're going to talk about. And just to sum up what we got going on here, the top 5 sectors account for 78% of the ETF. All right. Don't worry about those bottom 3. They're not going to help. The top 5 stocks. All right. So I'm going to have to wrap it up here, but thanks very much for tuning in, and remind yourself to stay on trend.